Welcome to the Link edition for this week. Good evening. Thank you for joining us once again this week as we continue to give you the information that you can use and opportunities. And we want to thank Standard Chartered Bank for adding support to us as the sponsors for the Link to facilitate our bringing you information that you can use. Tonight we're speaking about an element of taxation. And in the studio I have the right person to talk about this, Mr. Maurice Agaba, who's the tax manager at Deloitte Uganda. Mr. Agaba, welcome.
Thank you so much.
Very good. The thing we're talking about tonight, viewers, is something called transfer pricing. You may be wondering, what animal is that? Let me turn to Maurice. Maurice, tell us, what is this animal called transfer pricing?
Thank you so much, Sam, for this topic tonight.
Yeah.
So transfer pricing is a technical word in taxation, but for purposes of our viewers, I try to speak to it in a layman's term.
Yes.
So transfer pricing can be considered to be an arrangement under which enterprises that are under common ownership or common shareholding try to set prices for transactions they have. Using an example, a simple example of Nation Media Group.
Yes, yes.
So we have NTV Uganda.
Yeah.
We have the Daily Monitor. If, for instance, NTV Uganda was to provide services to Daily Monitor, then the price that you charge when you provide the services to Daily Monitor would be considered to be a transfer price.
Okay.
So you're setting a price on a transaction that you're having with a rated party. In Uganda, we have a legal framework under which transfer pricing is looked at. And this is the transfer pricing regulations of 2011. This is an instrument that was put forward by the Minister of Finance. And in the following year, May 2012, we had the Commissioner General of URA. At that time, that was Mrs. Allen Kajina, publish what we call a transfer pricing note. This transfer pricing note is meant to guide taxpayers on what documentation should be put in place to meet the requirements of the taxman. Why is it so important?
Yeah, what's the big deal if NTV gives services to Daily Monitor? We are doing business.
Exactly. So still I'll use a simple example.
Yeah.
If, for instance, you're approached by your sister to extend financial assistance to her, you might decide to extend a loan to her at 0 interest rates because she's related to you.
Okay.
You might then say, I do not need any form of guarantee or security for this transaction. And again, you can pay as and when you wish.
Okay.
However, if I approached you as a third party, someone you don't know, you might say, well, I'm giving you so much money. I want you to pay interest on this transaction. Give me security in form of a car or land, and I would expect you to pay in a period of 3 months. Now, the arrangement between me and you, a third party, is very different from the arrangement you had with your sister.
Yes.
Now, taking that to a transaction between NTV Uganda and Daily Monitor, so if you charge the price to Daily Monitor that is below the market rate, then the revenue you recognize as NTV Uganda is way below the market expected revenue. Okay. And in the eyes of the taxman, that's an issue. You've eroded your tax base.
Oh, okay. Go on.
Yes, so what the transfer pricing rules prescribe is that as you transact with the rated party, and this is mostly on cross-border transactions, you need to benchmark the prices you charge against market prices.
I can't charge less.
Yes, you should charge a price that mirrors the market price. If you don't, then we call that you're eroding the tax base in Uganda.
Okay.
Yes. So that's the reason why the taxman should be interested in this transaction.
Okay.
And you mentioned about what companies should be concerned about transfer pricing. So multinational enterprises.
Okay.
Now, these are entities that have presence, that do business across tax jurisdictions. If you have a presence in Uganda and also have presence in Mauritius, the corporate income tax rate in Uganda is 30%.
Yes.
In Mauritius, it is 15%. So like I mentioned, I can decide to transfer profits from Uganda a high tax jurisdiction at 30% and have those profits taxed in Mauritius at 15%. So in the eyes of the taxman, the activities generating the profits are taking place in Uganda, but then Uganda is not receiving a fair share of the profits. The profits are being taxed in Mauritius at 15%, and Uganda is losing out on its share of the tax revenues.
Okay.
So this still extends to domestic entities, but there is a threshold that should be met for transactions between domestic entities to be under transfer pricing rules.
Okay.
So the threshold is 500 million Uganda shillings. So if you have domestic entities that are transacting, but the transactions are below 500 million, then there's no risk for transfer pricing.
Let's just go back to that, what you said last. Threshold, transactions below 500 million. What does that actually mean?
Thank you so much for that question. So I still use the Nation Media Group. It's a domestic group. So if you have transactions with related parties in a year of income, normally for a taxman, we look at a normal year of income that runs from July to June. You can choose a substituted year of income, which should be any year of income, a 12-month period that will end, say, December or January. So in a given year of income, your transactions with related parties should not exceed 500 million shillings. If they do, then as per the TP rules or the transfer pricing rules, you're expected to demonstrate to the Revenue Authority that you're transacting at market prices. So you prepare what we call a transfer pricing report.
Okay.
That report should be in place by the time of filing your income tax return. Ordinarily, companies are given up to 6 months after year end to file their income tax return. So as you file the income tax return, you must make sure that you also have the report. There are penalties if you do not have that report in place by the time of filing the income tax return. And this is how it happens. So if the commissioner should ask you to present your transfer pricing report, you're given up to 30 days from the date of receiving the request to submit a transfer pricing report. If you don't, there's a penalty of up to 50 million Uganda shillings. That's about $13,500 US. So it is important that companies or viewers that have related party transactions do prepare a transfer pricing report.
So below, Maurice, below 500 million, I can do what I want.
Correct.
No one will, look into my, my business. But as long as I go above, let's say, 500 million, then URA starts to say, so if I'm at 499, I can do what I want, but above, then I start to go to market price.
Correct, but that will apply to domestic transactions.
International ones, what's the threshold?
Cross-border transactions, there's no threshold. Any transaction must meet the arm's length principle. That's a technical word. It must mirror market prices. Yes.
There is something you said earlier, eroding taxation. I mean, if I am dealing with NTV and dealing with Daily Monitor and we are doing business, we are favoring each other a little bit. How am I? It's a survival thing. How am I eroding taxation? After all, at the end of the day, I will compute and say, this is the money I've got. What's the issue?
Good question. So eroding the tax base. So each tax jurisdiction should receive a fair share of tax revenues, especially if activities generating those revenues are taking place in that country. So if you, for instance, structure transaction, like I mentioned, Mauritius, Uganda, and activities are actually taking place in Uganda, but you intentionally transfer the profits from Uganda to Mauritius.
How can I do that? We have a few minutes. How can I do that? How can I transfer my profits?
Yes, very good question. So I'd still use an example of financial assistance. So I have an entity in Mauritius, I have an entity in Uganda. So I decide to receive financial assistance from an entity in Mauritius. What the Mauritian entity will do is to overprice the interest they recharge to me. Accordingly, that interest is an expense in my books in Uganda, but it's interest income.
Tax deductible.
Exactly, tax deductible. So that way, interest income is going to be recognized in Mauritius and taxed in Mauritius. In Uganda, it's going to be an expense. I'll take a deduction for it in Uganda.
I see that.
Yes. So that's
how about in the case of me monitor? I mean, me NTV and Daily Monitor.
Very good. So for domestic transactions, there is a tendency for entities, to load costs under an entity. So an entity will be loss making for as long as it's operating. And so in the tax law, if you report tax losses, then you shielded from the tax net.
Yes. Yeah, absolutely.
So an entity in the group would be receiving support, service transactions, purchase of goods
from the other one,
and then to be loss making and to not be reporting any taxable profits. Yes.
Okay, I get it.
Yes.
Final question, Maurice, before in about a minute and a half.
Yes, please.
So how do I navigate? I'm a law-abiding citizen. I have. Ugandans are creating some companies. I won't mention names, but some companies are several, apart from national media.
Okay. 2
companies, sister companies, 3 companies. How do I navigate this issue so that taxman doesn't now disturb me?
Sure. So, again, making reference to the transfer pricing rules.
Yeah.
One, you need to transact at prices that mirror market prices.
Okay.
And that must be documented. It's not word of mouth. Once the taxman comes over to you, you need to demonstrate that you transacted at market prices.
Yeah.
You prepare a transfer pricing report. It should be in place by the time of filing your income tax return. Number 2 is there is documentation that should be put in place to support the related party transactions. If you receive financial assistance, a loan agreement must be in place.
Yeah.
Stipulating the terms and conditions of that loan transaction.
And I should show it to the taxman.
Exactly. If it's a services transaction, we need to have a management services contract in place.
Okay.
You stipulate the cost and the markup that is being charged.
Services means, for instance, I've got a consultant to go and work in the other company, but it is coming from this one, they are paying this other company.
Paying, yes. So there must be a service indicating the provider of the service, the recipient of the service, what the price or the management fee is, and how you determine that price. For a services transaction, the expectation is you determine a cost that you incur to render the service plus a markup. So that markup must mirror market prices. It should not be something that you think of and say, going forward, I'll be charging 10%.
Yes.
No. What's the support for deriving the markup that you add to the costs?
Okay.
And then, being in touch with your tax consultant, getting to know the changes that are happening in the URA. Recently, there was a law on exchange of information. So if you are not aware, the URA is reaching out to other tax jurisdictions, receiving information and trying to use that information to audit transactions between related parties.
Okay.
Indeed, they have created an international tax office which is conducting tax audits, and transfer pricing is an area of interest to the taxman. Thank
you so much, Maurice Agaba, tax manager, Deloitte Uganda, for sharing with us on this animal, especially the last one you said, the taxman is going behind my back. Me, I will say it like that, in another country to check on me if I'm not obeying the rules, so they are going to come on you with information. So please, be ahead of the game. As Maurice told us, talk to your tax consultant. You can go to Deloitte to help you on navigating this issue so you don't have problems. They don't audit you and slap you with the bill that's going to almost sink your business. That was the link. Thank you for joining us tonight. We thank Stanchart Bank for joining us and empowering us to give you information. That was the link. Thank you for joining us tonight.